Welcome to the Self-Wealth Real Estate Podcast with your host, Luke Boyron. Today, I'm interviewing James Knull. He is a very experienced real estate investor based out of Vancouver and Edmonton and runs a realtor business out there with 20 agents between the two cities. Not only does he own and run a successful real estate agent business, but he also invests in real estate heavily. He was an investor first. So we got into some very interesting conversations about different investing strategies he's had, what he likes, the active and passive side, his best and worst deals. And we also talk about infill developments and how building purpose-built rental housing, especially funding it through the MLS Select program, can be an excellent opportunity. And I completely agree with him. He's doing that in Edmonton, but I think there's opportunity for that in Ontario as well as Edmonton. So give it a listen. I think you'll enjoy it. And thanks for watching. Today, my guest is James Knull, who is an investor and realtor, leads a realtor team in the Vancouver area and in Alberta as well. James, welcome to the podcast.
Hey, thanks for having me, Luke. I'm very pleased to be able to chat with you today.
So tell me a little bit about your background before real estate. What did you do?
Real estate was really my first career. So before real estate, I was in university, and then I took what would basically be called a gap year. So I didn't know what I wanted to do with my career. After university, I was working at a gym as a personal trainer for a year, and in that year discovered real estate, and it was a downtown gym, so lots of business folk around who had lots to say about real estate. It got me really excited. Started buying properties, flipping properties, and I enjoyed that so much that I wanted to take it a step further, got my real estate license, and the rest is history.
Nice. Very cool. Okay. And so what do you do now? Tell us about what you're doing.
So now that solo practice as a realtor has grown into a real estate team, and we operate in two markets. We've got our office in Edmonton, office in Vancouver. We've got about 20 realtors between both cities that operate, and you know, we do most of our business as investors, about 80%, and everything from, you know, people flipping their first house right up to multifamily investment and everything in between. So, that's a bit of an overview of our realtor business. As an investor, I mean, I was an investor first, so I've chipped away at all kinds of different properties and deals over the years. Everything from, you know, rolling up my sleeves in my 20s to do a flip, to right now we're developing a sixplex to fill that missing middle in Edmonton using the MLS Select program. We've got a bunch of apartment buildings, still got some houses, built some houses, a few Airbnb vacation properties. Just dabble. I just really like real estate, so you know, I'll try a new strategy out for a few years, acquire some properties with that strategy, and then on to the next challenge.
Yeah, I love that. I do a bit of dabbling myself. So yeah, I definitely get it. And it's kind of, you test out a thing and what do I build a business around here? But it's still worth doing a little bit of a few things before it takes too much of your focus away. So definitely. The development's really interesting. So tell me a little bit about how you're developing a sixplex using MLS Select. How does that work?
Yeah, so we're in Edmonton. The city of Edmonton is really pushing for purpose-built rentals. If you visit Edmonton, you'll see all the new high-rises that have been built in the last 5 years are purpose-built rental high-rises, and there's a ton of them. There's very little apartment condo inventory being built, and the city's trying to expand that out into quote-unquote normal-size investors. So that's all institutional money building high-rises. But the average investor, for a couple $1,000,000 can buy a corner lot and build a sixplex or an eightplex. So the city of Edmonton has paved the way for doing that from a permitting, bylaw, zoning perspective. And then the affordability ratios in Edmonton are really nice. The rents aren't low compared to the price of the buildings. Or another way of putting it is the rents are similar to the rest of Canada, but the building prices are so much lower that, you know, instead of, you can hit the affordability requirements for MLS Select. So we're funding and building the project, and then once it's complete, we'll be putting our long-term financing in place using MLS Select, which for those of you listening who aren't entirely sure about MLS Select, if you Google CMHC MLS Select, you'll see all kinds of great info about it. But the key highlights are that the CMHC is giving up to 50-year amortizations, up to 95% loan to value, and better than average, lower than average interest rates if you can make your building either more affordable, which is very easy to do in Edmonton, more energy efficient, which is easy to do everywhere, but to increase your build cost, or more accessible. So we usually do a blend of affordability and energy efficiency to get our maximum amount of loan rebate, I guess is what you would say.
Interesting. That's, yeah. Do you know what is the criteria that they use to calculate affordability?
I'll talk in generalities because without having it directly in front of me, I can't quote to the percentage, but there's a sliding scale. So you get points, the more affordable you are, the more inefficient you are. And as long as you add up to 100 points on the MLS Select scoring metric, you end up getting the best possible loan terms. So you can get 30, 50, 70 points. And again, please just Google ML for everybody listening. Just Google it. You'll see a nice little spreadsheet that says affordability, points, and like criteria written into that spreadsheet. It's a really nice user-friendly table. So, it's something to the effect of 15% of the units need to be rented to households below the median income for the lowest point value, up to, I think, 50% of the suites need to be rented to below the median income. So the nice thing about Edmonton is that the median income is very high. So to hit your affordability criteria in Edmonton, you can still rent to quite a few people who can afford to rent based on the current rental rate. So that's what I mean by the ratios line up at Edmonton really nicely, because the practical application of renting at an affordable amount compared to the household incomes, there's a sweet spot there that exists in Edmonton, because the household income on average are super high, but the building price and the rents are quite low. So affordability is very achievable.
Yeah, excellent. Yeah, I know a little bit about the program because we are using it on one of our buildings. We just got our bridge financing, but we're getting CMHC MLS Select on a 17-unit building that we did. But it wasn't a new build. It was a conversion, which is easier to get away with on the energy efficiency side because you're improving what's there. For a new build, I'm sure the energy efficiency is so much more expensive that it's probably not worth it. But yes, accessibility and affordability. But the affordability point, we actually had a few units that probably were going to meet the affordability because they were very small bachelor units. And from what I recall of that, they weren't basing affordability based on unit size. So if you have very small units, for example, you're still renting at, whatever the criteria is, X percentage of median income. So it's affordable there, but it's actually, a 250 square foot bachelor. But that's still technically affordable or in the criteria. So there are ways to make it work. And did you say that MLS Select is funding the build?
No, we're self-funding the build and then exiting the construction process with MLS Select.
Okay, that makes sense. I've heard of people using MLS Select to fund builds, but I haven't been through that myself.
You know what? I when I was poking around the website, there was different construction loan options available. At the time that we initiated this build, it wasn't the right loan for us. So I haven't done a deep dive into that. Again, realtor, not commercial mortgage broker. But for those of you listening out there, there's a program there that can work and is working for quite a few developers. So
absolutely, and I think it's useful for people to hear that high level details about it so they can look into it to see if it's going to fit their specific situation.
Totally. Hopefully, this conversation inspires some people out there to poke around, look at it, and then build some housing for some nice people in your hometown.
Yeah, there's a lot of immigrants coming to Canada. We need more housing.
We need more housing for those people, yeah. And, it's up to us to provide it for them.
So what kind of, I don't know if you know specifically on the six unit you're building, what the lot size would be for something like that?
Yeah, our lot size was 50 wide by 130 deep.
Okay.
So this was a house that I bought many, many, many years ago. And, I thought, okay, this house is on its last legs. We can probably rent it for 5 to 10 years before it starts to really start to fall apart. And it was a corner lot. Corner lots always mean better development opportunities. And it was a pretty big lot at 50 by 130. So that was, when we bought it, we thought, it'll make a good rental property for now, and someday maybe we'll build something, and what we build there will, we'll see when we get there. And, fast forward 10 years later, and the property needed enough renovation that we thought, you know what, instead of slapping $30,000 of paint on this thing and lipstick or whatever, let's just go for it and do the development. So the timing was right. But yeah, to answer your question, 50 by 130, we probably could have squeezed in an 8-plex, but when we ran our numbers and did our analysis, we figured that 6 generous sized units were going to be a better fit for the site than 8 really tiny units. That was kind of our final decision. And the factors that played into that was that we figured that bigger, more spacious, slightly more expensive units would attract more of like a family crowd. They'd attract more of a long-term tenant. It's one step above a starter property, so it wouldn't be people that we're going to turn over at a very rapid rate. And then same thing for the basement suites. The basements would have been very tight bachelors, whereas now they're very spacious one bedrooms that would be more than appropriate for a young couple. Again, something that people would stay in for a longer period. So, we thought about the ownership experience in terms of a slightly more stable, slightly more long-term tenant profile, not just trying to maximize the numbers, that in making our final decision to go with fewer bigger units instead of more smaller units.
Yeah, and it's interesting thinking about how the city you're in and the tenant demographics might impact the type of units you want to build. It's interesting thinking about it in that way. Do you find, so with that lot size, you have no problem fitting enough parking spots for everyone on the lot?
Yeah, no problem. Because it is a quarter lot, we could fit, along this way and then up this way, we could fit like 10 cars on the street.
Yeah, the 130 deep it's pretty good. So
yeah, and then we have a triple garage with pad. So, there's 3 single garage slots with 3 pads big enough. So we have 6 parking spots tandem technically on site. And then, we're the first building like this within 2 or 3 blocks. So it's mostly a 6-plex in a neighborhood of houses. So parking is not going to be an issue.
And that'll also be appealing to the tenant pool who, some of the neighbors in the neighborhood might not like it, but too bad. We need to intensify.
Yeah. I think that the house was becoming enough of an eyesore that the neighbors are more than happy to see a sparkly new building go in its place.
Yeah, no, that's great. Okay. Yeah, I love the idea of this. What do you have a pretty good idea of what your build cost is going to be?
Yeah, it's about $1.1 million ended up being our build cost, just around $300 a foot. Oh. And we put in a few, again, our plan is to own this thing for the long term. And one of our objectives was to have longer term tenants and an easier time as owners owning the property. So we invested a little bit more in a couple of features that make our lives as owners easier. One of those features being separate meters for every single unit. Now the building is technically on paper a triplex with basement suites. So each slot of that triplex could have had its own meters, but then we're constantly doing the management of utilities between upper suite and lower suite. Maybe utilities are included. There's all kinds of messing around with utilities that, it's 10 minutes here, it's 20 minutes there, but compounded over 15 years of owning this thing, and it's just a whole lot of extra pain in the butt. We also saw that utility prices in Edmonton and Alberta especially have been spiking, like skyrocketing by the gigajoule. And so to have separate utility meters allows us to tell the tenants all utilities are in the tenant's name and they're completely responsible for their own utility use. We don't have to either collect back from the tenant on a monthly basis, which is really administratively impractical, or include the utilities in the rent. This allows us to have the utilities in the tenant's names, and then any fluctuation, volatility, or collection issues are now on the tenants. So that was an upgrade that I think is going to be more than worth it, knowing that we're going to own it for the long term. Doesn't necessarily make the building worth as much as we paid for it, but it'll come back in time.
Yeah.
The other thing we did is we have exterior entrances into the basement suites instead of going inside the building with an interior staircase. There's a exterior excavated concrete staircase going down, which added a bit more interior square footage to the basement suite, and gives that true feeling of separation where the tenant isn't going into the back door and then down. They're actually going into their own staircase, into their own door, into their own suite. So again, pretty expensive with the concrete work, but I think that'll attract more tenants and then keep tenants a little bit longer because they'll have an enhanced feeling of privacy and security.
Yeah, no, I mean, it definitely adds to the cost. The last duplex I did a concrete walkout and it wasn't nice. Yeah, just a concrete kind of staircase out, and it was about 25 grand just on that. So in Ottawa, but yeah. No, I like that idea a lot. It's interesting that they're considered triplexes with additional suites, but then CMHC is still considered a commercial because it's 6 units. And I think that the 6 versus 8 makes sense too, because at least in Ontario, typically when you go 8, the hydro utility requires you to do additional upgrades that you have to pay for to the hydro capacity, and that can add an extra $50,000 to a build cost on an 8-plex. So suddenly going from 6 to 8 doesn't make so much sense. But on top of that, when you sell this thing, if you ever want to in the future, there are some lenders who would consider this a residential property for financing purposes too.
Yeah.
Like RBC funds, in my understanding, assuming it's the same in Alberta, RBC funds 6 units as residential, but then other lenders you can go commercial. So you kind of have both options, which is nice to have.
Yeah, I mean, this thing is technically strata title, so we've got 3 titles. So that was the last kind of little perk that we threw in and paid a bit extra for, so that from an exit strategy perspective, if it makes sense to sell it as a one big old unit to an investor, great. Or if the market flows in a direction where these individual units are selling quickly and for a premium, then we've got the freedom to do that as well.
Interesting, yeah. So for in Ontario we call that condos, but yes. So there are 3 condos, 3 duplexes that are each condominiumized. So they're their own. You can sell 3 condos. That's interesting, and that's a good way. You could sell it to investors, and obviously you have a good investor base as well with your realtor business. So that's also a good exit. It's interesting that CMHC sees that as a $6, but I guess that makes sense because they're fine if a building is all strata. If you own an entire apartment building and it's all strata title, they're fine financing that as well.
Yeah, the way they're looking at it is under the umbrella that is the building, there are 6 units, and that's good enough for them. Nice. And that's, that style of investing is getting super popular in Edmonton. I can't claim I'm doing anything particularly revolutionary with this. There are a ton of people building 6-plexes and 8-plexes on corner lots, 6-plexes on inside lots, and then even in our greenfields. So, with Edmonton, it's just never-ending suburb. And it's, farmers' fields getting munched up and turned into new subdivisions. Even the greenfield developers at the edge of the city are putting aside lots to build 8-plexes like this, like row townhouses with suites. So everybody's getting in on the bandwagon, and CMHC is more than happy to fund these things.
That makes sense. Nice. So going back to your realtor business, and we'll start with Vancouver and go to Alberta after, Edmonton after. What do you find the market was like? What were your investor clients buying in BC? And how has that changed recently, and where do you see that going in the future? I know it's a multi-part question, but
yeah. I mean, I think the dividing line is pre-interest rates going up and then post-interest rates going up. Pre-interest rates going up, the thing that worked really well in Vancouver was furnished rental. Vancouver is notoriously expensive with lower rents in relation to the purchase prices. But we were finding that if you furnished a unit and then rented it on a multi-month basis instead of an annual year-by-year basis, that was cash flowing, or at the very least breaking even for most properties. Even into properties that were premium, like condos downtown, we're seeing that type of break even. So that was super popular. It's in the past now, so it's not, it's tough to get excited about that. What we're actually noticing people starting to go back to is what we from Edmonton used to jokingly call Vancouver style investing, where people are speculating on the equity to the point where they're willing to take on negatively cash flowing properties. So essentially the philosophy behind it is, and a lot of people invest this way, is that they are buying properties that are negatively cash flowing, putting aside a cash buffer in place to feed the negative cash flow. And then from a tax perspective, the appreciation is a capital gain, which is gain taxed at half tax. Well, simultaneously, the expense of getting that gain, the negative cash flow, is a full write-off because you're writing it off against income. So in a roundabout way, there's a tax efficiency to taking negative cash flow if you're seeing it as the negative $50,000 over 5 years of negative cash flow. It just counts as part of your initial investment. You write off 100% of your initial investment for 50% tax back on the other end of the gain that you're speculating against. If that was a little quick, I apologize for everybody watching, but there's a tax maneuver there at play, and we're seeing people go back to that, where they're just buying good properties in good locations, speculating on the growth. What does that mean? It means land. People want good lots in good locations. So lots that are flat, that are easier to build on, lots that are close to parks, lots that are close to schools. And then we're also seeing there's a SkyTrain Metro Line transit train going from Surrey out to Langley through Cloverdale. And so all that property in Cloverdale and in central Langley is getting picked through pretty aggressively right now. And Vancouver's always been popular for pre-sale. We've seen a ton of our clients just go back into banking a few pre-sales, especially when interest rates really jumped. Developers had a mini panic, dropped the deposit amount, increased the incentives, cut out assignment fees. And so people were buying pre-sales that were 3 or 4 years out to say, okay, well, interest rates are high. I've parked my money. And then by the time it's time to close, we're speculating on interest rates coming back down. So that's become really popular. And I would say us personally, because we try to help our investors make good investment decisions, we paired the Langley LRT or Langley SkyTrain corridor with pre-sales. So we sold a lot of pre-sales where the train is going in Langley. I know that was a bit of a long-winded answer, but that's
that's perfect.
In Vancouver now that the interest rate has come back up.
Okay. And do you find you have a lot of flipper clients in Vancouver?
We deal with a few. They make up a part of our book of business. But flipping is a part of every market. And when interest rates are higher and growth is slower, a lot of flippers typically slow down because it's easy to look like a genius when the money's cheap and the market's going up. You could have made that money in 3 months without even doing the renovation if you're in the right market. Whereas when the market's flat and the interest rates are high, the numbers get a lot tighter. You have to be much more professional, much more skilled to make flips work. So we have seen the armchair flippers back away from the market, but people that are, professionals, contractors, people that know what they're doing, people that can control their costs, they're still flipping. So relatively speaking, there's fewer flippers in the market because the only people who can really make it work, from my perspective, are the quote unquote professional flippers.
Yeah, we've seen that as well. Obviously, with our wholesales in Vancouver, there's a lot less interest for flips. And that's why, as I was telling you earlier, we're flipping a few of them in Vancouver ourselves. Because sometimes we get good deals, and if nobody wants them, it makes sense. We're not just letting them go. Might as well make money on them. Awesome. So what about on the Edmonton side? What did you find kind of pre-interest rate hike was interest for investors? How did that kind of change as interest rates started hiking, and what are you seeing going forward?
Yeah, Edmonton was kind of a funny market because interest rates were super low, affordability was high, purchase prices were low. You could literally throw a dart at a map, and whatever that dart hit, you could buy it and it would cash flow. The challenge at Edmonton is that because the market stalled out in 2015 and equity was growing aggressively everywhere in the country, it seemed, but Edmonton, a lot of people were tentative about going into Edmonton. So the challenge was all of the numbers were terrific from a cash flow perspective, but nobody wanted to buy in Edmonton. So there were a lot of investors were getting into Edmonton just for cash flow. Multi-unit buildings like basement suited houses, 3-suite houses, or 2-suite houses, upstairs, downstairs with laneway were really popular. That was what people were stocking up on. Very, very easy to flip because construction costs were low. There were a lot of distressed properties, in terms of what we were talking about, distressed property and distressed seller, tons of that in Edmonton, lots of flippers flipping, lots of flip to yourself style investors where people would just renovate it as a purpose-built rental to the point where you could do the renovation and pull 100% of your initial investment back out. Those numbers worked in Edmonton pre-interest rate. now post-interest rate, everything's kind of at a break even. And with all of the incentives from the city and from CMHC for purpose-built rentals, we're seeing a massive migration towards purpose-built rental, either self-built or purchasing finished product. That's become super popular. And then there's still a ton of flippers flipping because the numbers still make sense, because it's still easy to get relatively inexpensive properties in Edmonton. The thing in Edmonton that does not work, that's kind of a no-go, are condo properties. There's no such thing as pre-sale in Edmonton. There are no new condo towers under development. Nobody buys a condo to rent it out. Most condo boards at Edmonton have gone restrictions on Airbnb, so there's not really an Airbnb market. Edmonton isn't really a vacation destination to begin with, so Edmonton's Airbnb market is really more so directed to niche travelers, either business travelers or people coming from rural communities for special events like hockey tournaments. It's not just, this is an awesome place, everybody wants to come here, it's a hotel alternative. It's much more niche for the short-term market. So Edmonton is poised for tons of new Canadians coming, for tons of really good jobs, affordable cost of living, and just providing, mid-range affordable housing. That's going to be Edmonton for the smart money investors over the next, 5 to 10 years. And, we're already seeing it. The institutional investors are building tons and tons and tons of purpose-built apartment high-rises all over the city where, it's like a 30-story building, everything's glass, it's brand new, it's sparkly, and the top floor is a world-class amenity deck.
Nice. Yeah. We see that a lot. You see a lot online about, people talking about being priced out of, Ontario, BC, and choosing to go somewhere like Edmonton or elsewhere in Alberta just for affordability reasons. Some people still want that house in the suburbs and they can't buy it around Toronto, so they can go to Edmonton and get that house in the suburbs, so long as they can either work remotely or find, good paying local jobs.
Yeah. Oh, there's a lot of good paying local jobs. I mean, the tech sector isn't quite the same, but there's a lot of construction manufacturing jobs. And yeah, I mean, for $750,000, you can get, a 2,500 square foot house, double or triple front attached garage, 4 or 5 bedrooms above grade, 3.5 bedrooms above grade, with a below grade basement that might either have a 1 or 2 bedroom suite in it, or the ultimate rec room, man cave, or playroom for the kids, or a couple of bedrooms. For less than $1 million, you can get a pretty amazing house.
And what does kind of a starter detached run you? Got 1,200 square foot bungalow or 2-story?
Yeah, 1,200 square foot. Now, are we talking? Yeah, 2-story is going to be smaller than a bungalow because it's 1,200 feet over 2 levels, so it'll be 600 in the basement, 1,800 total. Whereas a 1,200 bungalow will be 2,400 on 2 levels. So, let's go like, when I think starter, I think what could someone on a tight budget who's either new to Canada or just getting started, you could buy a half duplex with a single front attached garage, 1,200 to 1,200 square feet, 3 bedrooms on the upper level with an ensuite bathroom and a bathroom, and then a half bath, and then a reasonable sized kitchen, living room, rumpus room on the main level, and a 600 square foot basement that could just be another bedroom, rumpus room, playroom, or whatever, in a respectable part of town, like somewhere where you're not scared to go out at night, like safe, good school walking distance for the kids, for like $350,000, $370 maybe.
Yeah, see, that's quite affordable compared to a lot of people who live in Ontario. Compared to Toronto, that's non-existent anywhere around.
Yeah,
no, it's a little bit.
What I just described in Vancouver would be a $1.2 million property, 1.3.
Yes, absolutely. And it's funny because that would be sizable enough for people in Vancouver, because they might be going from a tiny little, condo in the city or something, little apartment to that, and they consider that, a home they can grow into with their family kind of thing. So, yeah, different markets allow for different kind of size houses and different priorities, for sure. So, tell me a bit more about some of the other investing you do or have dabbled in. What other things do you like?
Yeah, do you mean in real estate or in non-real estate?
Let's stick to real estate.
Okay, good. Yeah,
really interesting non-real estate.
yeah. Okay. Just confirming. Yeah, I mean, I went through a phase where I got really into multifamily. Loved working the cap rate, like boosting the net operating income. Ended up with about 15 apartment buildings at one point, and then we've sold off some of the underperformers and scaled that back down to a select handful. So really, really like the multifamily game. The thing that kind of put me away from that is I've really, really reestablished my priorities, as you could probably tell when we were talking about that sixplex, to ease of management, brand new, low maintenance, higher end tenant profile. Whereas the multifamily inventory in Edmonton is all of these buildings that were built in the late 50s, 60s, and early 70s that are walk-up style apartment buildings. You know, that those are abundant. They're reasonably priced. You know, you can still get them for 100 to 130 a door. And, they're all old. So you can, if you buy one for the right price, you can renovate it, pump up the rents, increase the net operating income, and do a refinance. So that's been very interesting to me. I got into building luxury houses for a little while in Edmonton. We have the average lot size in the inner city is 150 feet wide by 150 deep. And so the city of Edmonton allows you to split that into a 25 by 150, which is still a pretty reasonable size lot, and then build two houses where there once was one. And in order to make the numbers work, those houses need to be pretty large and pretty high end. So I built a dozen of those, just building and selling.
Nice. Did you usually sell them before building? Like, was it? Did you build it spec?
We almost always built them spec. And I'd say about half of the time we sold them before construction was complete, and about half of the time construction was complete, and then we sold it as people were touring them and buying them.
Okay. And you never sold them before you built?
We never sold them before we broke ground. No. We usually would list them for sale in the last 2 months, where people could kind of walk through a semi-construction zone and get a feel for what they were buying.
Yeah, I think a lot of people feel more comfortable with that, for sure. There's something physically there, and you kind of can get a feel for the quality of the build and stuff like that.
Exactly. You know, for the large developers who are building 400, 500, 600 homes a year in the suburbs, greenfield, reputable builders, people will buy those before ground has been broken. That's a big part of the Edmonton business model. And then those builders offer the service where you can design and customize most of what happens in that house, which people like to do. Because then you're living the suburban dream of your customized, beautiful, big old house in the burbs for $500,000 to $750,000. That's popular in Edmonton. But when it's a small builder in an infill scenario who's only building a few a year, there isn't the same trust level. So people want the proof of concept that it's going to get built.
That makes sense. And so you've stopped building those infills?
That's right. Yeah. Stop building the infills, and now we're building this sixplex infill. So actually working with the same builder that built a few of our houses, and now they're just building this project instead. So we've got a great relationship with them, and we've just changed what it is that we're building.
Nice. And did you find it was just better to keep them as rentals, or did you not like building the infills to resell?
The houses made sense as sale. We built them for sale. They, somebody could have bought them and put a secondary suite in to have a mortgage helper, but they were never designed as income properties. They were designed as homes. Mm-hmm. Whereas this sixplex, we've thought it through and put in all kinds of different features to make it friendly for us as owners, like the separated utilities and whatnot.
Nice. Okay. I'm curious about your kind of mindset on your active businesses versus your passive side, because obviously your realtor business is a very active business. Building spec homes is very active, whereas a sixplex is active to a certain point and then becomes passive or more passive. What's kind of your philosophy in what you choose to do, or how much you choose to do on the active side versus the passive side? And
yeah, I mean, one of my philosophies, I'm big on diversity, so that's why when you asked me what else I invest in, I said, do you mean in real estate or otherwise? I definitely take it to heart that nobody's able to outsmart the market, myself included. So instead of trying to go all in with one strategy or hang my hat on one location or one type of building, I want to make sure that I've got all kinds of things in all kinds of places, so that no matter which way the market blows, I've spread it around. So to speak of an active versus passive business, a big part of my philosophy with real estate is trying to create multiple streams of income and then have those multiple streams of income interact with one another. So for example, the spec homes, I thought, well, it'd be nice to sell some of these. So instead of trying to find listings, I'll just create my own listings, and then it vertically integrates my business. Or, instead of I want to own some of these purpose-built rentals, instead of buying them as a finished product from somebody, why don't I build them myself? As out on the realtor side, I don't actively take on a client list. I actually just manage the company. So while managing the company is quite active, it gives me more of a 9-to-5 feeling workflow, because I'm not the one taking clients for showings evenings and weekends, which is a big part of being a realtor. So in a way, owning that real estate firm has an active component where I get paid my salary. But then there's also a passive component where, it's a business, it's profitable, and there's an annual dividend for myself and my business partner as owners. So again, that takes one stream of income, which is selling houses, making commission, and has now put it into 3 streams, which is if I take a client, I can earn commission. The business itself needs someone to be the general manager. So I've appointed myself as that general manager, and I take the salary for doing that. And then as the business owner, it creates my dividend. So even that has, and so depending on, again, what the market conditions are like and what circumstances are like, I can lean into any one of those 3 areas to balance out my income streams. And that's just from the one business. And then that business services all of my real estate investing. And then the real estate investing has the active component of developing and building, and then the passive component of the cash flow of what we own.
Nice. No, I love that. I love the business side of these things too, because obviously, I love real estate itself. I'm very big, real estate. My life's around real estate, and so I love it. But I also love the business side of it and building a business out of my passion in real estate. So that's what I've done. I love seeing others who have done the same. Digging a little more into this, for some people who are kind of trying to balance multiple things, what does kind of your team look like when you're building all of these different things? Not just, let's say, the realtor side, but when you go and build a spec, well, not a spec, but you build these 6 units, or you're building those new homes. How much of that do you have to do yourself? Are you relying just on directly you communicating with external experts who help you? Or do you have kind of an internal team? Like for me, Erin helping manage this podcast, she's also a project manager on a lot of my flips and takes care of a lot of other things for me that I wouldn't be able to do on my own. But how does kind of your team work for you managing all of these different ventures at the same time?
Yeah, that's a great question. For me, we pay a little bit extra, and I have a general contractor. So instead of so I'm not the GC on my builds. I'm not organizing sub-trades, nor am I managing either a site foreman or a project manager. We hire a builder, and so I'm more of a developer in, I guess what you'd say, I'm not a developer builder, I'm just a developer. So I just arrange the ingredients. We find the land, we've got the capital, we find the builder, we crunch the numbers, we organize the financing, and then the project happens because all of those pieces have been interconnected. So the work really happens up front by setting everything up from the start. And then once that train is on the tracks, the builder we use has this really nifty program called Builder Trend. I don't know if I'd never heard of it until about a year ago.
We've looked into implementing it ourselves for flips. We haven't yet, but
yeah. Hey, from the perspective of a client, I love it. I can log in at any time and see like a real-time progress chart of everything that's been done. They take photos on site every other day. And it's just this online hub where it allows me to virtually visit the projects and see where it's at in real time. I love it. I mean, prior to Builder Trend, I would just have them take photos on site. And I'm more of I like to create accountability through surprise visits as opposed to scheduled visits. So that's just my personal style. Because I find that if there's always the possibility of a surprise visit, then the standard is kept a little higher. Whereas, it's like, okay, we're coming on Friday. Well, they've got all week to figure it out. So, a combination of using Builder Trend and surprise visits, I find keeps the project more on track. And but the level above that is great builder that I can trust, who I have a long-standing relationship with, who does a great job.
Nice.
You know what I mean?
Yeah. So kind of external companies that you work with, experts. Do you use consultants for like the land severance and things like that when you need to?
What do you mean by land severance?
Like when you were doing those builds, you were buying 50 by 150 foot lots, dividing them into 25 by 150.
Oh, you know what? I did that myself. It's the paperwork and whatnot with the city, and the permit application was pretty straightforward. That's an easy do-it-yourselfer.
Well, that's one of the nice things about Edmonton. That's for sure. Yeah. It's not so easy in Ontario. We've had some ridiculous situations out here, but
it's the same in Vancouver. I don't know how anybody managed to build anything around here with how long everything takes.
Yeah, awesome. Well, let's move on to the next segment of our show, where we talk about the best and worst deals that you've ever done and kind of lessons you learned from it. So let's start with the best deal you've ever done, if you don't mind sharing that and some numbers around it. Best or your favorite deal?
Yeah, I mean, this one, I hate to say this was more dumb luck than my own skill, but boy, I sure felt good about it. Because, it just goes to show that timing is often everything, and sometimes you're in the right place at the right time. I had this, so there were a couple of houses. So a developer had done exactly what we talked about. Bought a lot, subdivided the lot, built 2 houses on the 2 lots, and they built these houses with secondary suites. So this whole situation was 4 units sitting on 2 lots. And, because when we were building them in more luxurious locations for owner occupancy. This was built in a more tenant-friendly location, so they built it to tenant spec. Upstairs suite, downstairs suite, 4 units. And I had been keeping my eye on, and this was right before COVID, so I had been keeping an eye on this thing all year. And they started them at about $550, which I thought was about the right price. And then they kind of got caught. So Edmonton's extremely seasonal, so they got caught up in what I call the winter chill, which is, you drop the price by $10,000 in September, but it's already too late. And then you drop the price by another $10,000 in October, and it's already too late. And then you drop it by another $10,000 in November, and it's already too late. And then you drop it by another $10,000 in December, and it's already too late. And if they had just dropped it by $20,000 in September, they would have got it sold. So I kind of watched them. I like these properties. We were actually marketing them to our clients because I thought this would be great for somebody to own. These are really nice houses. For whatever reason, they weren't sticking. So I got to know the owner of the properties very well as I tried to sell it to other folks, which also gave me the ability to say, look, 20 of our odd clients have said no to these properties. Like, I don't know what's wrong with them, but you guys are holding on to something that people don't want to pay that price for. So winter came along, they had dropped the price to $499, so it was now $50 below their initial list price. And then COVID hit, and they were just, it was a bad scene. They had been paying all these carrying costs, whatever. Now COVID's happening, the sky's falling, everybody's wiping their groceries, and nothing will ever recover again. And there was just that, like, for about a 4-week period in March there, everything just hit rock bottom. And so, I said, I've been watching these properties long enough that, like, I know them, I'll buy them, but, like, you have to give me a spectacular deal and I'll buy both of them and I'll close right now real quick. And they said, sure. So I ended up getting the pair for $450 each. And within 12 months, the value of them was up to about $575. And again, I was just right place, right time, paying the right attention to the right property. And so that was pretty cool, because that was like Vancouver style appreciation in Edmonton,
Yeah. Do you still own them today?
Yeah, I still own them. They're great. The tenants are great. One of the 4 tenants is literally the first person that moved into it when I bought it. So, that's a 6-year tenant. Well, no, wait, that's not 6 years. It's more of a 4-year tenant, 3.5-year tenant. Anyways. And yeah, they've, the properties are brand new, under warranty. Everything's all good.
Do you know what the rental rates are currently?
Yeah, the 2 uppers are at about $2,300, and then the 2 lowers that are at about $1,100.
Okay, so about $3,400 in rent on a $450 purchase each.
Yeah,
pretty good. And do the tenants pay their own utilities?
Yeah, the tenants are paying utilities.
Is it common out there to pay their own water as well, or is that usually on the landlord?
So yeah, we don't have, all of our utilities are separate from the property tax in Alberta. Okay. So water, electricity, and natural gas, which is what we use to heat the houses. We don't have electric heating really out here. Those are 3 separate utilities that are billed out separately. So nothing's included with tax or anything like that. So water, think about water like a separate utility.
Nice. Okay, that's great that you separate it. Yeah. It's funny how some cities, Ottawa charges it separately as well, except if the tenant doesn't pay it, it's under their name, they'll add it to the owner's tax bill. So,
so it never intermingles with municipal tax. So the water is a separate utility. So if the tenant stops paying utilities, then the utility company, which is called EPCOR, will start sending the owner a bill because the tenant stopped paying. So what we end up having to do is there's a part of the lease that basically says that if the tenant stops paying the utilities, it'll get billed back to the tenant, just to make sure that as a landlord you're protected. But yeah, it's a separate utility. It has nothing to do with the municipality.
Nice. Okay, cool. Very cool. Okay, so what lessons would you say you've learned from buying those two properties?
I think a big part of it was, if everybody's scared, it's almost always a good time to buy. Like if everybody's panicking and prices are dropping, that's a good indicator. And I think and it's easy. It's always so easy to say that in retrospect, but in the middle of COVID, when everybody was panicked and the world was ending and oh my God, and all the prices are dropping, everybody was scared to take action. Like everybody froze. Nobody was buying anything. Everybody was, there were a lot of people selling off stuff because they were like, if I don't sell it now, I might never ever get to sell it. And the lesson is always in those rare moments of where everything aligns and there's a bit of a panic, it's always a good time to buy. And it always is a shorter duration than it feels like it's going to be in the moment. And it almost always resolves itself quick. Like we had a version of that where interest rates spiked. Oh my gosh, nothing's ever going to be the same. And everybody stopped buying. And, December, January from 2022 into 2023, there were all kinds of opportunities because everybody froze for a minute because of an external stimulus making everybody panic for a second.
Yeah.
And, here we are 10 months later, the market's kind of just reharmonizing. So there was a buying opportunity.
Well, and I'd see the same thing with our flips. You hear often that now is not a good time to flip. And like you said earlier, for professional flippers, it can actually, in a way, be a better time because you have less competition for the purchases. There's less competition for the unrenovated properties. So it can be a better of a time to buy, as long as you do need to be more careful. You do need to make sure you're quick, because in the past, you could take a year to renovate a property, but the market went up in the year and you'd be selling it at a premium. So you made more money. But now, even if it's only flat and doesn't go down over a year, you've still got all that carrying costs and everything with no, I'm not saying no appreciation, but you don't want to count on it. And so, all those extra costs are going to eat into it. So some of our properties we turn over in 2 weeks. Some of them take several months, some of them take 6 months to renovate. Depends on the extent of the reno. But some of our flips, we can finish in 2 weeks, just get in, get out, move on to the next one. And now people are scared to buy, so it's given us more opportunity. So tell me about the worst deal or your least favorite deal that you've ever done.
Yeah, my least favorite deal was 2013, 14, 15, and Edmonton, Alberta is, it's a notorious boom-bust economy. That was a booming time. And so very similar to what's happening right now, rents were escalating. And in Edmonton, there's no rent control. So when rents escalate, you can just up the rents by whatever the market will bear. So we were in the multifamily game. We were increasing net operating income. We were doing basic renovations, and things were moving fast. So, we would buy a building where the average rent per suite would be $1,000. We'd paint the hallways, do some groundskeeping work, just give it a refresh. And now all of a sudden the rents are $1,100, $1,125. And so we ended up getting ourselves into the refinancing game because money was cheap. Like our interest rates were 2.5, and second mortgages were available at like 7 to 8.5. So we were buying, refinancing at 8%, buying another one, refinancing. And we ended up, kind of having this interlink of 5 buildings where we had increased the value of this one by like $800,000, 600 as a down payment on the next one. Now we're taking that and buying the next one. And so we ended up getting 5 buildings for the price of one, essentially, because of how rapidly the market was rolling. And then, we kind of, instead of capping it and getting rid of all of the second mortgages and flipping everything into long-term CMHC, we just got a little too high on ourselves and just, let it ride, get the next one. And then In 2015, oil plummeted by like $80 a barrel in 5 or 6 months. The entire Edmonton market just kind of froze. Rents started plummeting. And so we ended up having 5 buildings with pretty reasonable first mortgages, but then everything had very expensive second mortgages at like 7 to 8%. So everything was over leveraged with really expensive interest. And rents started like going from $1,400 for a 2-bedroom back down to like, $13, $12, $11, $10.50. And all of the big institutional landlords, so the 2 biggest institutional landlords for that asset class in Edmonton are Boardwalk and Main Street. And they basically said, we're getting ahead of this. We've got deep pockets. We just made a bunch of money. So that all of the big players started offering incentives of like no damage deposit, 2-3 free months of rent, which basically just obliterated all of the stall time landlords, like anybody with 200-300 doors or less. It's very difficult to compete with that. So we were in a situation where we could spend $10,000 renovating at a place only to re-rent it at $200 less while having to give a 2 to 3 free month rental incentive. So it got really, really ugly. And, luckily between myself and my partner and our partnership group, everybody was doing pretty well, but we just had to feed those things to the tune of tens of thousands of dollars for a couple of years in a row. And it just really sucked. Almost overnight, because all those big companies started offering these monster incentives, well, the best tenants with the best credit in every single one of our buildings, like the best quarter of all of our tenants, basically just jump shipped and move across the street to Main Street and Boardwalk buildings overnight for these incentives. And by the time we were able to react and catch up, we'd already lost all of our best tenants. So now we have buildings that are 1/4 vacant, and the 3/4 that are left are our least favorite 3/4 of the tenant profiles. So, we weren't the only ones that got hit really, really hard during that time. Like I had a lot of colleagues and fellow investors who were in the same boat, but it was a rough time for us and a rough time for a lot of people. And, we made it through the other end, mainly by virtue of very, very strong incomes in our partnership group being able to feed the properties. But if that hadn't been the case, a bunch of those properties, we would have had to walk away from them, which would have been unfortunate. So it was nice to be able to keep them, but it sure was an expensive lesson in over leveraging.
So I was going to ask, what were the lessons?
Yeah. The lesson was, it's kind of a funny thing, because the lesson was the punishment you pay, like, high leverage is a sword that can cut both ways. But if the market had just kept going up or even just flatlined and stabilized, we would have looked like geniuses. So, in my own personal investing, as you could tell by the type of product that I'm approaching and the way that I'm approaching it now, like much more risk adverse, way less leverage, sticking to newer product that's going to attract tenants in all markets. So, like the lingering effects of what I learned from that experience are affecting the way that I invest now. And so I always tell people it's very, very sexy in the real estate investment world to try to buy stuff with zero money down or, borrow your down payment. But if the market goes sideways, that can really, really, really cause a problem. And I think a lot of people are going to be more conservative now with interest rates being higher. But it's still, leverage can really, really, really hurt. And yeah, having a cash flow crunch basically just stalls everything.
Yeah. Well, and I think one of the other lessons was it was good that you and your partners had the ability to get money elsewhere to fund that, or you really would have been screwed if you didn't have income from anywhere else and you were only reliant on that. That definitely would have been worse. And yeah, I think those hard times are what makes us better investors, right? That's when everything goes easy, you don't learn the hard lessons.
Yeah, exactly.
Yeah, no, that's good. And so you've sold some of those buildings now, or do you still own some of your apartment buildings?
Yeah. Once everything kind of stable, because there was a time there where if we sold them, we were on a couple of them, we would have sold them for a loss, and we would have had to pay the purchaser, as it were, because we were underwater on the equity because of the leverage being so high. We were at 95% loan to value. So if the building value goes down by 10%, well, now you're 5% behind. So once everything stabilized, the buildings that fared well in neighborhoods that were improving, we kept. And then the buildings that just, after a 5-year period, for one reason or another, it always seemed that the tenant profile wasn't very good, or, et cetera, et cetera. We got rid of the ones that just weren't fun to own.
Nice. Yeah, it's always good. I think there's always a point where you have a kind of an accumulation phase where you buy a bunch of buildings or properties, and then you kind of have a phase where you cull the herd and find the sick properties and get rid of them, the ones that are always causing problems. So
yeah, that's been like the last year and a half for me with the market being a little more active. Is I've cut out about 50% of my properties over the last year and a half, and then redistributed that equity into either deleveraging the ones I own, or moving that money into other investments, or just keeping it liquid to get ready for the next phase of acquisition. Because I think the next 5 years in Canada are going to be very exciting with all the new Canadians, with the student housing crunch, with new incentives coming out. I mean, they're talking about cutting GST on new construction. There's a lot of really cool stuff going on in the Canadian marketplace, and I think it's going to be a good time to be well positioned to be a part of what the next phase of Canadian real estate investing looks like. So, I didn't want to be carrying any dead weight or have any anchors taking up mental bandwidth or underperforming. So, it's all about pruning back to get ready for the next round.
Awesome. All right, we're going to move on to our final questions. First one is, what has changed about your approach to real estate investing with your experience?
Yeah, less leverage. Being less aggressive with leverage. I think early on, I also felt like the returns on paper needed to be sky high for investors to be interested. And so to make the returns sky high, you have to drop the investment, which means more leverage. But over time, I realized that investors are just as interested in security as they are in seeing a big number on paper. So finding that balancing point in terms of being a little more conservative has actually made it easier for me to raise capital and invest.
That makes sense. Yeah. Looking at the risk-adjusted return, right?
Yeah.
Nice. Okay. Next question. If you could go back in time, what's one piece of advice you'd have for a younger you?
I would say focus more on location. All of the properties I bought that have been the worst performers, I bought in not so great locations because it was a good deal. Oh, it's the price is great, the cash flow on paper is high, but I've almost consistently across the board had bad experiences in bad locations, no matter how good the property was on paper.
Makes sense. Okay. And lastly, what is the most overlooked or the most overhyped investing strategy right now?
I would say overlooked. I would say probably, I don't know if it's being overlooked anymore, but these purpose-built rentals. I think it's a great time to get into purpose-built rental. It's expensive and it's complex because of development, but I think with where the Canadian economy is going, with where Canadian law is going and where immigration is going, purpose-built rentals are the spot. So I would call it overlooked, except I think a lot of people are looking at it. I would still consider it overlooked. Like you have more of the experienced investors are looking at it, but there's people talking about it, but I still think there's not as many people doing it as they should be. I still think it's overlooked. Yeah. I think overhyped, again, to tie into my comments about leverage, is this drive towards other people's money or borrowing multiple pieces from multiple people and being at 100% leverage, zero down, borrowing as much money as you can, borrowing money from, vendor takebacks. Like, there's a place for those kind of deals, but I think often what it ends up doing is creating over-leveraged situations with risky loans, because as much of a pain in the butt as it is to work with an institution, you know what you're going to get. When you do a private loan with a private person, there's all kinds of X factors. You can open a can of worms doing a private loan with a private person who doesn't have a lot of experience, who may be working with a lawyer that doesn't have a lot of experience placing private loans. So there's a lot of hype because it seems like buy a bunch of real estate and have no money and use other people's money. But then the reality is it's a lot more complex than people give it credit for. And there's a lot of points of failure that don't enter that conversation.
Absolutely. No, that's a really good point. Okay, James, where can people find out more about you, about your realtor business? If they want to get in touch with you, where can they find you?
I love email. That's the easiest way to get a hold of me, James@mogulrg.com. Our website's mobilerg.com if you want to poke around and see what we're up to. Give us a message there as well. And then, I'm a millennial, so I still hang out on Facebook more than Instagram. So if you look up James Knull on Facebook, that's probably my biggest social media presence and the easiest way to get in touch with me through that channel.
Okay, awesome. James, thank you so much for joining us. I think this was a really good perspective for for us who've had a lot of more Ontario-focused investors on here. So it's nice getting that kind of balance with the other coast, a bit of BC and a bit of Alberta as well. So I think people are really going to find this interesting, and I love the development side of this. So thank you so much for joining us.
Yeah, it's been a pleasure. Thanks for having me. Really great conversation. And for everybody out there, it's going to be a great 5-year run in Canada. So make sure you get your piece of it.